Welcome to this explainer. Look, we hear so much noise out there about getting rich quick, but the actual data, it tells a totally different, honestly much more fascinating story. Today, we're breaking down the hidden barriers that are actually keeping you from building wealth, and we're going over the proven tools you can use to break right through them. All right, so here's our roadmap for today. First, we'll look at the hidden barrier and the silent wealth killer. Then we get into the good stuff, the magic of compounding, index funds explained, and learning by doing. Let's just dive right in. Section 1. The hidden barrier. Why wealth stays in cash. Okay, so we usually just assume that a lack of money is the only reason people don't invest, right? But I want to pose this question directly to you. Why do even wealthy people keep their money in low-yield cash? You see, we kind of assume that having money automatically means knowing how to invest it, but that assumption, it's actually completely wrong. Just take a look at the reality exposed by this London School of Economics study of UK households. It is wild. Even among households sitting on over £250,000 in investable assets, like people with serious money, a massive chunk of them are just hoarding it purely in low-yield cash. Literally, they are systematically missing out on historical market returns. But why? Well, the crucial point here is that financial literacy is the actual friction. Get this, only 22% of UK households actually hold stocks. The LSE study proved that stock market participation strictly increases with financial literacy, not just the size of your bank account. People with money are keeping it in cash purely because of intimidation and a lack of understanding. Non-monetary friction, which is essentially just the fear of the unknown, that's the real barrier to entry. Section 2. The silent wealth killer. The danger of lifestyle creep. This perfectly illustrates what actually happens when you start earning more money. Imagine two totally different paths after a $10,000 pay raise. Person A takes that full raise and spends it on a new car lease, a way nicer flat, and going out to eat all the time. The extra wealth they actually saved? Zero. Nada. Now, person B, on the other hand, decides to save just 50% of that raise, so $5,000 a year, and invest it at a historical 8% return for 20 years. That single, simple decision creates an extra $247,000 in wealth. Same salary, exact same starting point, but totally different lives. So, the psychology behind person A's behavior. It's a little thing called the hedonic treadmill. Basically, as humans, we rapidly adjust to improved circumstances. So that fancy £60 dinner? It just becomes your new baseline expectation, and suddenly your old favorite takeout kind of tastes like a disappointment. You require ever larger spending just to maintain that exact same level of satisfaction. To combat this, you can use the 50% rule, just like person B did. Basically, whenever you get a raise, allocate half of it straight to investments before you even think about upgrading your lifestyle. It's a super simple, totally mechanical way to just stop the treadmill in its tracks. Section 3. The magic of compounding. Let time do the heavy lifting. $1 million. I know, that number sounds literally impossible to a lot of people. But as investor Charlie Chang breaks down, if you invest just $500 a month at an 8 to 10% return for 30 years, you're going to end up with somewhere between $680,000 and over $1 million. And honestly, the crazy part, the vast majority of that final number isn't even money that you put in. It is the exponential growth of compound interest. Time is quite literally doing the heavy lifting for you. Section 4. Index funds explained. Betting on the whole race. So, if compound interest is the engine, index funds are the vehicle. I absolutely love this quote from Charlie Chang. He says, if you pick one stock, it's like betting on one horse. An index fund is like betting on the whole race. See, when you buy a single stock, you basically have to be perfectly right. But when you buy an S&P 500 index fund, you're buying a tiny slice of the 500 biggest companies in America all at once. You get instant diversification. So if a few companies fail, it's totally fine because you have hundreds of others picking up the slack and pulling the weight. Now, when you actually start looking at index funds, you're going to see two terms pop up a lot: mutual funds and ETFs. Let's just clear this up right now. A mutual fund, like Vanguard's VTSAX, for example, is bought in dollar amounts, and it only trades once a day, right after the market closes. An ETF, on the other hand, which stands for Exchange Traded Fund, like Vanguard's VTI, trades all day long exactly like a regular stock, and you can buy it by the share or even just a fraction of a share. Honestly, for most beginners, ETFs are the absolute easiest entry point just because they're so incredibly accessible. And the best part about these funds? It's how unbelievably cheap they are to own. Take a look at this comparison. The expense ratio is basically just the fee the brokerage charges you to run the fund. Vanguard's total stock market funds charge about 0.03%.
which is virtually nothing. It's like $3 a year for every $10,000 you invest. But then look at Fidelity. They actually offer zero index funds, like F0RX, which have an expense ratio of literally 0.00%. Zero. You can own the entire stock market race for absolutely free. No way, right?
Section 5. Learning by doing. Start small, grow smart. Okay, so the single most empowering finding from that London School of Economics study we looked at earlier, it's what researchers call the catch-up effect. They found that financial literacy gaps across gender and education actually shrink through hands-on experience. The very act of putting your money into the market actively builds your financial literacy. You do not need to be some sort of Wall Street financial genius to make your first investment. Taking the action is actually what creates the knowledge.
So here is exactly how you can start building wealth today. Step 1, open a brokerage account. Whether it's Fidelity, Vanguard, Robinhood, Public, honestly, it doesn't really matter. Pick one. Step 2, link your bank, fund the account, and buy a low-cost index fund or ETF. And then step 3, which is the absolute pro move, automate the whole thing. Set a recurring buy every week or every month. This lets you dollar cost average into the market, and it completely removes human emotion and, let's be real, forgetfulness from your wealth building.
Wow, okay, we have covered a lot of ground today, from the psychological traps of the hedonic treadmill to the absolute mechanical power of index funds. But I want to leave you with this final lingering thought. When that next pay raise comes, are you going to let it slip away into a slightly nicer car and a slightly better flat? Or will you pay yourself first, break through that barrier of intimidation, and actually buy your piece of the race? The math is clear, the tools are out there for free, and honestly, the choice is entirely yours.